of retirement and planning for it are two different things. When it comes to retirement planning, it means that you're more proactively engaged and you want to create a life for yourself in the future where you're living it on your own terms. And if you're 45 plus and you are still wondering about financing your golden years, you're at the right place. This is a special series, a special show where we tell you all about planning for retirement with life insurance. I'm Karunya Rao, and joining me today are three very special guests: Ms. Joydeep Kumar Roy from PwC, Professor Prasanna Tantri from Indian School of Business, and Mr. Srinivasan Parthasarathy, Chief Actuary at HDFC Life. Gentlemen, thank you so much for taking time out and joining us for this conversation today.
Thank you, Karunya.
With the change in lifestyle, improving medical infrastructure, amenities, medical treatment, etc., we are seeing a very sharp improvement in life expectancy. Whether it's the social structure as well that's moving towards nuclear families, it only emphasizes and reiterates the importance of financial planning. But how many of us are really thinking on those lines? If we were to live, say, another 25 years after our retirement, which is the age of 60, are we prepared for it? Joydeep, my first question is to you. What kind of proactive thinking or planning one should start doing so that they can secure their golden years after retirement?
See, the most important factor here is a mindset, because with each age bracket, our mindsets are concentrated towards certain priorities, and retirement planning, which is 25, 30 years ahead, normally is not there in our list of priorities. And that's why you'll see in Asia, people start saving for retirement very late. Earliest probably in Korea and Japan in the mid-30s. India, there have been studies which show that till 45, 47, people don't think of retirement savings, mostly also due to the fact that the allocation coming out of surplus doesn't happen really before that. However, the longer you can really plan for, the surer you are for your retirement. Remember that one cannot also plan retirement 25 years hence based on the current economic scenario, and therefore one has to extrapolate and stress the plan to something like, let's say, a zero interest or a very low interest kind of an environment, and therefore it becomes a very, very involved, very long-term exercise. Needs to be done by, of course, professionals. It cannot be done by oneself all the time, because one is always trapped in the present. And that's the biggest challenge, how to really do it. And that's why most people end up not doing it, unfortunately.
The ongoing pandemic has clearly brought about a great deal of uncertainty, financial struggles, financial hurdles for many people out there. A few months of disruption with even, things like a pay cut or a job loss has presented people with an enormous financial challenge. We've all seen things playing out in that way in the last 1.5 odd years. How does the guaranteed proposition of an insurance-based retirement plan help in this scenario? If Mr. Parthasarathy could step in and tell us a bit more about, how insurance could really help provide that cushion.
Yeah, thanks, Karunya. We talked about the life expectancy is sort of increasing with every passing decade. The Institute of Actuaries of India, which is a professional body for the actuaries, have conducted a study recently, a couple of years ago, where they've shown that the longevity of someone who is just retiring, say at age 60, has actually increased from, say, 82 years it was when the study was last conducted in late 90s, to now 85 years. So an increase of 3 years over a span of 17 to 20 years. So it becomes a little bit of a challenge for those who want a guaranteed income in retirement. Currently, the people who retire rely on fixed deposits and maybe gold to a large extent, where they park their retirement corpus. And as we've seen recently in the last few years, the FD rates have actually fallen quite dramatically. It used to be around 8-9% a few years ago, and now it's hovering around 5 to 6%. And gold, doesn't really, give any income of sorts, but people do have a emotional connect with gold, so they do tend to invest in gold. So this is exactly where the life insurance products come into play. And annuities, what the products that the insurance companies offer, provides a guaranteed income for the rest of the lives. And this is probably the only product in the world that can offer this kind of guarantee for the entire lifetime of an individual. And that's exactly where, if you look at, say, the NPS, which is the PFRDA's product, encouraging people to save for the retirement, and where at the time of retirement, there is a mandatory requirement to buy an annuity, so that people are secured with a certain amount of minimum guaranteed income during the retirement phase. One key advantage these annuity products offer is it takes away the longevity risk, which is the risk of living long, from away from the customer or the annuitant, and passes on that risk to the insurance company. So that's the main sort of a thrust of this product, the annuity products. And again, here you have broadly, two different types of annuities, which are one where the purchase price or the corpus is returned on the death of the annuitant, and the other where the on death no corpus is returned, but it is compensated for by a higher income while the person is still alive. And you can also buy this annuity product on either on a owned life or single life, or also cover the spouse also. So in case the main life dies, the annuitant dies, on the death of the annuitant, the spouse also gets income after the death of the annuitant. And again, you have two types of products. You have immediate annuities and deferred annuities. So immediate annuities is probably most preferred for someone who's just retired, and deferred annuities are those who are still in the working population. Maybe I'll talk about these two in a little bit more detail in later parts of the conversation.
Sure. I'd like to steer the conversation towards Professor Tantri. How are the trends when it comes to buying insurance when it comes to retirement planning? Could you tell us a bit about how the trend has been, and is it on the is it on the up move, or will it take some more time for people to largely subscribe to these offerings?
Yeah, I agree with the panelists before me. We are nowhere close to optimal, and the penetration levels are quite low, and there needs to be a significant mindset change. But what I would like to add to your previous question, since you asked a question about insurance, people need to distinguish between the accumulation phase and annuity phase. The kind of instrument that you need when you have 30 years to go to build a corpus is very different than the kind of instrument that will give you annuity. People need to differentiate between accumulation phase and retirement phase. Instruments required are very different. I don't see an appreciation for that. Same product, same either debt throughout or equity throughout, that doesn't work. My recommendation is, if somebody 30 years from now should think of equity during accumulation phase and then go for annuity during retirement, whether it's immediate or deferred, that can be seen at that time. But I think insurance plays a critical role in both phases. There are equity linked insurance schemes as well. One significant advantage that I think insurance provides for others is the discipline and need to keep paying. I think that's where its advantage is.
Joydeep, would you like to add something to this?
Yes, Karunya. In fact, very interesting aspects brought out by both the panelists. So let me just make 2 points. One about guarantees. Yes, deferred annuities are probably the best guarantees that you can get today. Now, under the circumstances that we are of a volatile interest and volatile equity markets, and people always think of a guaranteed retirement. Now, guaranteed retirement has got a flip side. The guarantees are constant in the sense that when you retire, whatever be the age, then the problem, and as you heard, that it's not a question of longevity at birth. Longevity after 6 years of birth and longevity after 30 and after 60 are all different. And people who have led a very active life till 60 are today, the average longevity is 85. By the time another 30 years pass, it'll become probably 90 or 92. So the question is, how do you really stay on that guarantee from 60 to 92? Think about the same salary for 30 years. Can anyone survive? So that having the same guarantee also is a problem because of rising medical costs, rising living costs, and other kind of occasional costs that must come in. So one has to look at a serious planning of how one can blend in different things. Yes, annuities will have a place. Maybe fixed deposit and gold will also have a place. Maybe rental income will have a place because that can keep on increasing. That is the inflation adjusted, and some such instruments which will give uh, kind of a cover against inflation. That is extremely important. Second thing, the sub part of that is kind of health cover. Health insurance is going to become very, very expensive in the older ages, especially with chronic cases, even if it is available or not available. But even if it's available, it's going to be expensive. So planning for that, because healthcare costs can take away the entire all other money, and in fact can make somebody go down the entire curve, and that's been proven through many academic studies. One of the major causes of poverty is healthcare expenditure in India. The second point I want to make is about the age of retirement. If we are talking of the Gen X, Gen Y, Gen Z today, who are not even wanting to talk about long term beyond 5 years. Nobody's looking for a long term career. We've all heard about the great resignation which has happened post COVID, accelerated the digital careers and startups and the gig economy. If we try to extrapolate it for next 20, 30 years, when does one plan to retire? Is it 60 or is it going to be 40 or 45? And by retirement, I mean stoppage of a regular income, and then one can do whatever one wants to. But one would therefore need different instruments to think of, start very early, if at all, and build a corpus or a wealth, or build instruments through which one can stay on longer from, let's say, age of 45 till age of 90. I think that is the bigger picture which we might miss if we stay on to the older paradigm of retirement in 60 and having a guaranteed income after that. Guaranteed income after that can only be sufficient if one moves back to a village or ancestral village or something. One cannot stay in a big city and keep up with the living standard one is used to.
Uh, Ms. Parthasarathy, post the pandemic, have you seen a significant improvement in trends in demand and in terms of acceptance, especially when it comes to millennials or zillennials, as we call them?
So what we've seen from our data is people really think of retirement planning in the 50s, when they're in the 50s. While yes, people want to retire early, but they are not really adequately provided for the retirement at their young ages. There is a difference between what they want to do and are they really ready for it. There is a significant gap at the moment. I totally agree with the other panelists when they said, annuity is not really an inflation-proof product. But unfortunately, that's the best bet we have for getting a guaranteed floor of income. I also agree that you cannot put all your money in just an annuity and hope that you can survive for the next 25, 30 years. It has to necessarily have a bouquet of products because you need some real assets to provide for inflation. So, like Joydeep mentioned, rental income is a good real asset. You would also need to have some equity component in your product. So, annuity only provides a basic floor or a certain minimum level of guaranteed income, but that's not sufficient in its own. So, you need to really supplement it with other real assets. And yes, of course, you cannot invest everything in equities when you are 60. So that's really a very risky proposition. But you need to sort of, what financial planners typically talk about in terms of a bucketing approach, where you bucket your outgo needs or the liabilities or your expected outgo over the next, say, 1 to 3 years time, and maybe 3 to 5 or 5 to 10 and 10 plus or something like that. And then probably put more of fixed income products for the shorter ones, and maybe 10 years plus or maybe 20 years plus income needs in real assets like either property or equity. But across all the durations, the annuity product will provide a basic minimum level of income. I think that should be the strategy. But in terms of whether people are, especially the Gen Zs and the millennials, whether they are really adequately prepared and planned for the retirement, unfortunately, the answer is no, not yet. But they do want to retire soon, but they probably need a lot more, in terms of preparedness.
Okay. Professor Tantri, inflation has been a huge concern and a huge factor that people typically factor in when it comes to future planning, retirement planning specifically. What are some financial measures that you can take, so that when you are retiring or when you're closer to the retirement age, you don't have to worry about higher inflation rates or inflation overall as a point of worry?
Yeah. So just since an academician, I just have to mention that, that inflation sometimes can be nasty and you can't do anything for it. If you have a situation like Venezuela and Zimbabwe, then no amount of planning can help. But expected inflation, yes, you need to take into account. People, especially compounding over long period of times, people have problem estimating numbers. I'll give you an example. If you're spending 100 rupees today in a year, 30 years from now, even at a 5% inflation, you will require 450 or 430 odd. And another, and as someone mentioned before, even after retirement, your spending will keep increasing at the rate of inflation. So ideally, you should people should have an idea. Obviously, no one knows what's going to be the inflation over next 30 years. You can, I know it's better to be patient, look at data and keep adjusting. But given what we have, for the next some years, 5.56% seems reasonable for a country like India. And if the first step is to, if I have to maintain my life standard, what is that I will be spending 30 years from now, 20 years from now? And also keep in mind that even after retirement, inflation is not going to stop. It's not enough if I get the same amount for next 30 years. Inflation will be there. So the corpus that you're going to accumulate should be such that it will give you the same standard of life for the next 25 years of life. So you have to take into account inflation after retirement also. It should be a balanced portfolio that accumulates a corpus that gives you that kind of money, which is not equated, which grows with inflation even after retirement. So I agree that people have problem in compounding, so with stock markets, we have seen this. Many studies have carefully shown, like with estimation of COVID cases or any of these cases, where once it becomes exponential, people have difficulty. We all think linearly. That's the problem. So this is not linear.
So, Karunya, just to bring in one interesting thing I think needs to be talked about here. See, all this is coming from the point of view when we talk of interests or returns coming out of corpus. We are coming on from the point of view that as if we are saving all our lives, building a corpus, then we are living off the corpus, and then what happens to the corpus? The corpus will pass on to the next generation, right? Because we all want to leave a legacy. Now that holds good even with the properties that we own. Our cultural and subconscious, the collective subconscious, as it is called, which we have been built culturally over hundreds of years, is that we all want to leave a legacy for our next generation. Now that is a conflicting ideal along with a comfortable retirement. These two don't match. So it is obvious that if I have been working all my life and at age 60 I built a corpus, the returns of it can never match my previous income, and let alone the inflation. So that is a kind of an impossibility unless it is heavily equity laden, and the wealth creation is enormous. But if we think of everyone who builds, somebody who's built a house, typical the which one is living in, then one doesn't even have rental income, which is inflation proof. Then we have to think of reverse mortgage. We have to change the culture here a bit. If we have to, and I think Gen X, Gen Y, Gen Z will do that. The zillennials, the desire to leave the corpus for the next generation will have to be in a measured manner reduced, so that one can withdraw, let's say, the return and the corpus together, and to a situation where, like a reverse mortgage, that at death it becomes zero. So reverse mortgage has been used in many developed economies, and reverse mortgage doesn't necessarily need to be only with your house. It can be with your corpus too, where you take out the return and some part of the principal, so that at a certain age which you foresee, let's say 90, 95, your corpus has become zero. You can always we still pass on a legacy by doing a whole life term life insurance, which is available today. You can do till age 100, and rest assured that that at any point of time, if you die, even if the corpus has become zero, or you, because of reverse mortgage, the bank is going to take away the house, you still have the life insurance coming in for your next generation.
Right. I'd like to flag off what you just said. The fact that people tend to, start late, right? Typically, I think 40, 45 plus is a phase when most of us are in a good place in our career. We have bought a home, we've bought a car, we've traveled a fair amount. We've also started saving for our kids' education as well in many cases. But is it too late to start planning for retirement, Mr. Parthasarathy? Because for those who've not done it already, is 45 plus perhaps too late? And what are their options at that age and at that phase?
Well, Karunya, I think it's better late than never, I guess. So at least if they've not really started or done anything till they are 45, it's better to start right now at least. And there are multiple products that are available for people who want to save for retirement. I think the best product, as far as I know, that exists in our industry is NPS. It's a very low cost product. And it gives equity exposure as well, and a bouquet of fund houses. Choices also is available for the customer to select from the fin. There are about 11 NPS providers now in the industry, I think. And it's the charge is only 0.1% per annum. I think is the fund management charge. So that is one sort of option available for someone who's looking to build a corpus for the retirement, or any of these insurance companies, pension plans, which also offers which also provides equity exposure, is also available, and you get some tax exemption as well there. I mean, most of these are EET. So at least while they are accumulating, there is some tax exemption available. Or there are some products in the market at the moment where instead of you building a corpus, you can directly lock into the prevailing rates to get a guaranteed income, and you can sort of lock into the rate itself. So, for example, someone is say 50 years old and he wants to start the income when he's 60, then he can sort of start building this income stream instead of putting into a corpus, and then the corpus has to be then annuitized when he reaches 60. So instead of and he's leaving, he's taking a reinvestment risk, because we don't know when he turns 60 what the interest rate will be at that point of time. So to avoid that and to lock into the rates, because interest rates typically has come down over a period of time in various markets. So if he wants to lock into the current yields, you can buy a deferred annuity, which basically, instead of building a corpus and then requiring you to be annuitizing it at 60, it allows you to lock into the prevailing rates for the entire for your entire lifetime. But the flip side of this product is that it provides a guaranteed income and doesn't sort of offer any inflation proofing. But there are some other mechanisms where you can provide some kind of a protection against inflation, because some of these products are also available where the income will increase, say at a certain fixed amount, say 5%. One of our products offers a income to increase at a constant rate of 5% per annum, so which is not really fully protecting against inflation, but it does give you some sort of an increase in the income, rather than stay as a flat income for the rest of your life. But like I said earlier, you can also consider putting in some money in equities, that using the bucketing approach I talked about earlier. Because you should necessarily have some real assets in your overall corpus to protect yourself from inflation eroding your corpus.
Okay, but no matter what age we're in, we get used to a certain lifestyle, and we want to maintain it, if not upgrade it further. And if we have to think of it from this prism, is there a formula that would help us plan how much we should earn, how much we should save at the moment for our for this ideal future where we can at least we're able to sustain and maintain our lifestyle, Mr. Parthasarathy?
See, typically, the world over, the thumb rule, I mean, if you look at the defined benefit schemes that used to be there 20 years ago, and I think it still exists in some of the PSUs even today, the thumb rule typically people use is as a percentage of the last drawn income just before retirement. So if you get, at least you target a 50% of what you drew when you as a last salary on the month before retirement, I think that's a fairly decent thumb rule to adopt. But if you are able to target, say, 2/3 of your last drawn income, then you should be fairly okay. And this assumes that you have cleared all your liabilities, whether it's a mortgage or any other financial liabilities you might have. Plus, like Joydeep mentioned earlier, you should necessarily have a health insurance cover to take care of all the other health needs post retirement. So if you've done these two, I think 50% or 2/3 of your last drawn income is a decent thumb rule. And there are lots of websites which offer what are called retirement calculators. So they sort of take what is your current income and what is your salary inflation expected for the next 20 years. And so that they sort of forecast what your last drawn income is going to be. And then they say, okay, well, how much of your last drawn income you want to target post retirement. So there are some of these calculators that are available on several websites, and including HDFC Life's website, but other companies also offer similar tools. So you can use that and play around with that and get a sense of what exactly you want to target for, but have some target. So we can tweak the target maybe as you approach retirement, but you should start off somewhere and start with some target. But first thing is to appreciate that there is a need for you to plan for your retirement. It doesn't overnight, if you are 55 and then say, okay, I'm going to retire in 3 years' time, I don't know what to do now, then you're really leaving it too late. But I would urge everybody to sort of start thinking about retirement. How do I get the income post retirement, and start doing something from now on. I mean, whether you're 25 years old or 30 years or 40, whatever age you are at, it's never too late to start. So you please start something, and there are brilliant instruments. Like I said, NPS is a brilliant product, and some pension plans that are offered by different companies, they're also good ones to look at to start saving, or maybe annuity products like deferred annuity product.
Is there a recommended age? I mean, of course, you said it's never a bad time to start, but typically for young professionals or for students even who want to, at some point, if you want to educate them, what is a good age to start? What would you say?
See, I think in our country we have this concept of provident funds, right? So I think it's sort of roughly around 24-25% of your income is mandatorily invested in EPF. But only issue with EPF is it doesn't mandate you to you can withdraw from the EPF even while you're sort of earning for various reasons, maybe education or wedding or something. But I think if but it builds in the discipline of saving, or for retirement. And I think I would suggest that people don't see PF as money available on tap, and access it before they retire, and do sort of think of it as a pot they are creating for later years. So I think you should at least set aside 20% minimum, 25%, even when you're in the early 20s, is what I would strongly recommend.
Okay. Professor Tantri, let's talk about insurance vis-a-vis other asset classes, right? When we talk about fixed assets, whether it's gold, whether it's real estate, they don't account for regular expenses that one faces in post-retirement life. And if you look at other investing options, whether it's perhaps a fixed deposit, which typically has very low interest rates, which we've seen in the recent times. So how does a life insurance retirement plan help in this scenario? How does it peg versus how does it stand or stack up vis-a-vis other asset classes?
Yeah. So the way I see it, when it comes to the payout phase, which is when you draw your savings, I think life insurance is a very, very important tool, and the annuities these life insurance companies offer have a definite place in everybody's portfolio. Again, that cannot be the only one, and I think that's, it's superior to many other asset classes. You can't keep selling 1 gram of gold every month for expenses and so on and so forth.
Most of us, after, of course, the main point of investing is securing your future and having a safety net and a good corpus for whatever reasons that one may want to use that money for at a later stage. But post that, most of us would rank tax benefits as the second most important deciding factor, right after ROI. So post retirement, you would want to guard your corpus even more and ensure that you pay a very marginal amount of tax. So Joydeep, my question to you is, how does a life insurance product help an investor achieve that?
So at this point of time, you heard also that it is EET, right? So the final outputs are all taxable. So retirement income, pensions are taxable. And that's how I don't see it changing, because end of the day, we are talking of, and you only said it's not just a maintaining lifestyle, but increasing lifestyle. The need to, want to, greed to, aspiration, whatever we feel at age 25, we'll keep feeling at age 65 or 70. So it will not change. Only the order will change. So I think the most important thing will be to concentrate on the best courses of income, and I think a lot have been said on that. Absolutely, the if one has worked out the right mix between, from a pension scheme, from an insurance, normal insurance payout scheme, or let's say there are even lump sum payouts happening at certain ages, those come in and are useful. Health insurance, which will definitely guard one against any kind of a disaster, as well as then working on things like reverse mortgage, things, other investments like gold and rental income, one can sort of manage through. The only one aspect here on tax which I'd like to keep as a guidance factor for everyone is that uh, tax on the riskiest investment will always be taxed less. No, that's why the riskiest profession, which is business, is taxed the least, right? The risk-free salary is taxed the most, and that the principal will not go. And therefore, if you are heavy on equity and you can manage the risk even at an early, slightly later age, your returns from that and capital gains will always be on a scale of things taxed lesser than guaranteed income. So that's what has to be kept in mind.
Would you like to add to that, Mr. Parthasarathy?
Yeah, just a couple of points. So you have broadly under insurance, you have a pensions and a life segment. So if you buy a life product, which means that you have to have some minimum level of insurance cover in it, which would mean that the mortality cost will also be built into it. But what that does offer is a tax-free benefit. So the income that you get from a life product, which by virtue of the 1010D clause, if you have a 10x of the premium as a life cover in it, then the benefits, whether it is taken as one of lump sum or as a stream of income, will be tax free. So I have seen a lot of people do that because they want life cover also while they're while during their earning lifetime, and they sort of get 10x cover, and the benefit, they, instead of taking it as a lump sum, they take it as an income for a very long period, maybe 30 years or 35 years. So then that income is tax efficient. Or alternatively, I mean, this is what a life insurance can offer. But there is also another mechanism which I've seen people talk about is if you have a fund, instead of taking a dividend option from the fund, dividend option is now fully taxable beyond a certain minimum level. You take a systematic drawdown in the retirement. So any systematic drawdown will be treated as a capital gains. Will come under capital gains, and where, which is not as penal as probably an income tax would be. So I think these are the two sort of tax efficient mechanisms that I'm aware of that exist in the market today.
Mr. Parthasarathy, you also have a product called Systematic Retirement Plan, right? Can you tell us a bit about how that works?
Yeah, I again touched upon the the deferred annuity earlier. The deferred annuity is nothing but while you are in the working years, you can lock into the prevailing rates and get a income that is guaranteed from say age 60 or 55, whenever you want to retire. So someone is say 45 years old and he wants to retire from 60. So instead of building a corpus till 60 and then at the time annuitizing, he can instead buy buy this systematic retirement plan, where he will know that okay, if I pay X rupees of a premium for the next say 5 years or 10 years, I can get say some maybe 2x of the 2x as a yearly income for next 30 years, 40 years, from starting from age 60 or something of that sort. So that is what the systematic retirement plan offers. So it is a regular or a limited premium product where one pays the premium for 5 years, 10 years, and the income he will get will start much later, maybe when he turns 58 or 60 years old, and it will be paid for the rest of his life. So that is what the systematic retirement plan offers.
Okay. No matter how old we grow, we would always want to be financially independent. And this means that you have not just one, but often several sources of income so that you're secure from multiple ends, right? Professor Tantri, where does life insurance fit into this?
Yeah. So as I've said, all of us are familiar with that Ulysses story, right? The beauty with life insurance is discipline. I think those of you who have not read that Ulysses, while sailing through in a particular place where there used to be music, and everyone would jump out of the ship, and what Ulysses said, he sort of ordered his team to time up. So that he wanted to listen to the music, but at the same time didn't want to jump because of the music. So what life insurance does, because of this commitment, even if it's not contractual, because it's sort of framing, right? We have this mental accounting, and life insurance, we have this framing that it's long term, we have to pay regularly. And that, I think, is a principal advantage of life insurance over others, where the saver sort of thinks long term and thinks that he or she is investing on it because of a purpose. But overall, as I said, I think insurance will play an important role, and it should be there in every retirement portfolio.
On that note, gentlemen, we'll wrap up this conversation. It was very insightful, very engaging. Thank you once again for joining in and helping us understand the essential and a very vital role that life insurance can play when it comes to retirement planning.